Hi, and welcome to today's presentation, where we have the pleasure to present OrderYOYO. To help us through the presentation, we are joined by Jesper Johansen, CEO, CFO Jesper Hyveled, and Deputy CEO Mathias Thom, joining us from Germany. Today we will do this as an audio only, so otherwise there is no changes to everything. The event, of course, is your first half-year report you sent out there. You also had the trading update in July, where you made the upwards revision of your guidance, but I still think some news came out in this report, and I'm sure we will dig into that, especially on maybe some of the future targets. As always, ask your questions down in the box down below. Do it during the presentation. I will see if it fits in, or else we will catch up on all the questions in the end. But for now, I will hand the word over to you, Jesper.
Yes, thank you, Michael. And welcome everybody to this presentation of our first half 23. Yes, I'm Jesper Johansen, CEO of OrderYOYO, and I'm here with Jesper Hyveled, CFO, and Mathias Thom, joining us from Germany, our Deputy CEO. As you said, Michael, the numbers and results are as we presented in the current or the trading update in Q2 in July. So the numbers should not come as a surprise to you. However, the level of details is, as you say, much higher. So hopefully we can give you a little more insight on our numbers in this presentation. So let's get going. Next slide, please. Yeah, just before we start the presentation, just 30 seconds as usual on this important slide. Okay, let's start. Next slide, please, Michael. Yes. So first half of 23 was very strong for us, proving that what we do works. Delivering ARR growth of 47% to just below 250 million. And we increased EBITDA profitability significantly from a loss of 6 million in the first half of 22 to a plus of 9 million in the first half of 23. So very strong numbers that we are very proud of. Next slide, please. Now, this one we have shown and talked about a lot before, and the reason it is very important because it's about what we do in a nutshell. So we live at restaurants. 90% of the orders of an average independent restaurant come from recurring customers. The restaurants need to own these customers, and we help them claim them back. And on top of that, we can do this as much lower cost for the restaurant than the portals, basically cutting the cost for the restaurants in half. This has been our value proposition from day one. And our growth shows that we have a strong product market fit. Next slide, please. So as mentioned before, ARR of 246 million, 47% growth, and EBITDA of 9 million, profitable every month the last 12 months. Strong numbers that we are very proud of. And now let's focus a bit on the last part, on the profitability side of our business. So if you turn to the next slide, please, Michael. So profitability is key for us. It's an important strategic objective, and here we've shown you the EBITDA margin since 2021. Now, coming from a margin of around 0 in 21, we invested heavily during the first half of 22, transforming into a margin of minus 12% for the first half of 22. This fundamentally changed during the second half of 22, where we realized an EBITDA margin of around 5%. And we were growing this to just below 8% in the first half of 23. And for 23, for the full year, we expect an EBITDA margin of 6 to 9%. And we are confident that, and we expect that we, in the coming years, can drive this margin improvement even further. And the drivers of this market expansion are basically threefold. So it's local market leadership. It gives us a platform to deliver strong products at scale, more cost efficient. It's economies of scale. So as we're getting bigger, we do see cost advantages, and we're realizing them. The OrderYOYO machine is built for more activity, which basically means that added activity increases profitability. And then finally, there's M&A. So we can see that adding companies to our platform drives economies of scale even further. So we are confident that our EBITDA margin will improve in the coming years. Next slide, please. So just a little more on the profitability. The margin increase can, of course, also be seen in Danish kroner. So looking at the EBITDA per quarter for the last 8 quarters, the shift is significant, as can be seen here. And EBITDA per quarter has been improving been improved by almost 10 million from the second quarter of 22 to the second quarter of 23. Next slide, please. So this one is new and something that's also very important for us. We haven't talked much about this before, but now we will, and we will do it also in the coming quarters. The increased EBITDA profitability now also translate into a positive cash EBITDA. So what is cash EBITDA? So cash EBITDA is basically the reported EBITDA minus the investments that we do in R&D. So it's the operating cash flow for the business. So it's a very fundamental and important measure. If a company is cash EBITDA positive, it is basically self-funding and independent of external capital. So very, very important milestone. In June, we realized the positive cash EBITDA for the first time. A very important milestone that, of course, comes due to general increase in profitability that we've realized over the last quarters. And we expect to continue to be cash EBITDA positive from now on every quarter. So next slide, and over to Matthias, who will take us through our market leader position. Over to you, Matthias.
Thank you, Jesper. Yes, next slide, please. Size and profit matters. We created the platform for market share gains. As Jesper already mentioned, we made 246 million DKK based on our June ARR run rate. And in the first half of 2023, we had 9 million DKK in EBITDA, which is a very strong performance. Since last year's merger with AppSmart, OrderYOYO is the number one in Europe from the first day. We are market leader in the two largest takeaway markets in Europe, UK and Germany, and having also market leading positions in Denmark, Ireland, and Austria. Additionally, we initiated market entry in the Polish and the Swiss market. So size and profit matters, and this market leading position allows us to benefit from economy of scales, better resource allocation, more innovation on all levels for our restaurant partners, more bargaining power, suppliers, and it helps us to continue with our ongoing mergers and acquisition strategy. We see the benefits unfolding and continue to unfold over the next months. Next slide, please. Next slide. Can you see? Okay. Let's talk about the current external market conditions, which didn't change much from our last presentation. For restaurant partners and end users in the UK, the market conditions remain still tough, which is driven by inflation and various number of other macroeconomic factors. For Ireland, the situation for restaurant partners is moderate and remains tough for the end users. Denmark, Germany, and Austria will still face restaurant partners and have a moderate and steady situation. OrderYOYO proven a resilient and strong performance on all markets, with a growth of 29% in GMV in the first half of 2023 compared to the first half of 2022. We continue gaining market shares from both portals and other white label providers and expect to continue to do so. Now I will hand over to Jesper Hyveled, our CFO. Next slide, please.
Thank you, Matthias. And I will give you a few highlights on our first half performance of 2023. So next slide, please, Mike. So our 2023 guidance, last updated in July this year, is maintained. Our performance on all metrics developed as we expected, but we still see some uncertainties in the macroeconomic environment, as Matthias alluded to. So the guidance highlights are that our December annual recurring revenue is expected to be between 250 to 260 million DKK. Our net revenue is expected to land between 220 to 235 million. And finally, our EBITDA between 15 and 20 million. So all in all, strong numbers and numbers that we are proud of, and numbers that we do expect to deliver on in this year. Next slide, please. Now, taking a closer look into our ARR composition of June 2023, our ARR is divided into a usage-based and a fixed subscription base. Our usage-based subscription part representing 62%, which was characteristic for OrderYOYO 18 months ago, now including a larger share of fixed subscriptions representing 38% of the total ARR Overall, the mix of our ARR composition strengthening the health of our total ARR in combination with the country split composition, which combined give us a much more commercial flexibility and something that we use in our day-to-day work. Next slide, please. Looking at the consolidated June to June ARR development, we grew by 47%. Existing customers grew by 20%. New customers grew by 37%, and our ARR churn ended at 7.7%, which is a drop compared to our last reported ARR churn in our full year report from 2022. We're very proud of the growth in both existing and new customers, while the churn rate is considered acceptable in the current market situation, and as we do have a active churn policy in OrderYOYO. Next slide, please, Mike. Now, taking a look at our EBITDA or net loss bridge, our reported EBITDA of 7 million DKK transfer into a net loss of 17 million. Now, why is that? The explanation of the variance is mainly due to the capitalization of acquired intangible assets. For first half of 2023, the total depreciation amounted to 22 million, whereof the majority relates to acquired assets. Basically, this alludes to what Jesper was talking about our cash EBITDA. So most of the net loss here is explained by depreciations on acquired intangible assets, which is part of our M&A strategy, so a logic consequence of that strategy. So with that said, final comment from me. Over to you, Michael, for our Q&A session.
Yeah, perfect. Let's start with that, and maybe jump to this one. There's a question there. Will there be any extraordinary cost besides the M&A cost this year? I guess the 2 million, you explained the 22, the big drop down to the net income, which of course could worry some, but is, I guess, non-cash effect. But the 2 million there, is that all M&A? And will there be any other extraordinary cost if you don't do M&A, or is it solely M&A cost?
So it's solely M&A cost, and we do not expect any other cost than that. So that's also mentioned in our accounting policies. So M&A cost only, transaction cost, and you should expect this to increase in second half, partly due to Kingfood acquisition. That some of the cost relates to that transaction will come in second half, and then as we do have a M&A strategy, there might be other ones coming in.
Perfect. And then there's a question a little bit besides the half-year reported number. You continue to improve in EBITDA. What do you see as target long-term margins in your type of business? I know you're probably not going to answer that very clearly, but I will try. Secondly, is there some business you maybe are benchmarking you up against that you could give a feel for us investors that I sit and look at that and that I would like to achieve? But firstly, are you willing to give us some long-term targets, or secondly, maybe some feel on where you are looking at?
Yeah, I think. I mean, obviously, we do not have officially listed any long-term guidance or targets for our long-term EBITDA margin. So even though I would very much like to, I cannot do that. But obviously, we have. What I can say is that we have a strategy to improve EBITDA margin, and I think that it's fair to say that a business like ours. So a software business in general should be able to generate at least double-digit EBITDA margins, and preferably also in the late teens to the beginning of 20s. I think that is a normal level for a software company, and we're pushing to go beyond the current EBITDA margin that we have now, which is for the first half year 8%, and we want to increase that. You've seen the increase that we've had from just over the last 2 years. So this is a journey, and we're not finished on improving. Where the ceiling is and where the long-term target is, I can't be very specific about, but it's higher than the one that we have now.
Perfect.
And if I can add to that, I think everyone needs to remember that it's only transaction costs that we recognize as extraordinary. So additional, even though we do see upsides with the M&A strategy, we do have integration costs that we currently absorb in our P&L. So we do have cost in there that drives EBITDA down, but on long term we do see improvements definitely. But we do it with open eyes, and I think the last, as Jesper said, the last 2 years shows that we can deliver on that.
Perfect. I think that was quite as much an answer as you can give. So very thoughtful of that. Then there's a question here regarding your guidance. It's actually on your margin, guys. H1 net revenue minus Q1 net revenue equals Q2 net revenue of around 62 million Danish. If Q2 EBITDA is 6.3 million, then Q2 isolated has an EBITDA margin of 10.1. So isn't guidance of 6 to 9 a bit conservative? The question is.
Yeah. First of all, the math is right. So well done for the one doing that. The EBITDA margin for Q2 is 10%. And to the answer, are we a bit conservative? Yes, we are a bit conservative. I think we've been that and proved that over the last 12 to 18 months that's our strategy and the way that we guide, especially in an environment which is uncertain in terms of macro terms, even though that we are beating the rest of the players right now and are growing more than them. And also because we have an M&A strategy where there's a lot of stuff that can actually go wrong along the lines. But to the question, is an EBITDA guidance of 6 to 9% for full year when Q2 is 10%? Is that conservative? Yes, it is. Do I see anything specifically that I'm concerned about? No, actually not. So the math checks out, and the answer is yes, we are conservative.
And I guess the answer will be the same, because if I look at the decomposition, and I think there's also a question about the top line guidance, second half is normally seasonality, a better year. You are actually pretty close to the bottom of this, and new customers coming in this quarter is 42 million. So if you should also be able to have momentum on that. So am I doing wrong math, or is the answer the same?
I think that again the math checks out, and the answer is the same.
There's nothing you are seeing except the normal uncertainty that all businesses are experiencing. I think that was the answer.
But just a few one addition there as well. Remember that in the last quarter we did the acquisition of King Food. Obviously, that is adding to our new customers.
Yeah.
Our guidance is not with any M&A activities included. So obviously, that will be an extraordinary addition that we will report on separately. So that's also part of the explanation here.
Perfect. Then there's a question. The churn is falling. Is that a sign of change in the structure of underlying customer base, or is it in general that the economy hasn't been so bad? So the question is there some underlying change in the structure of your customer base that is driving the churn down?
Yeah, good question. I think two things here. First of all, in general, I think that even though that as Matthias said, the markets are still tough out there, I think there has been a slight improvement, number one. But number two, as we've talked about before on these calls, we are very picky and have been even more picky in terms of what customers or restaurant partners we end up partnering with, because we need to make sure that the partners that we partner with, that their chances of success in our system are maximized to the fullest. So you could say that we are also being better at onboarding the right customers in the last 6 months.
And then there's a question about the POS, but I also guess that the POS is part of the explanation why you now have 38% in fixed prescription. Is that also protecting your churn? You know, the more you're connected with the customer, the lower the churn should be expected. That's my first question, whether that's a part of this one. And secondly, are you seeing any development of the POS system outside Germany? So you are starting to get traction on that, and maybe that could even lower churn theoretically more.
Yeah. Number one, generally speaking, we do believe that selling more relevant systems to the restaurant, all centralized around the digital ordering. I think it's very important that our DNA is still creating orders and not just executing orders, which is the normal way of just having a POS system. So it's very important that we actually help the restaurant grow and that we generate orders for the restaurants. But when that is said, there's no doubt that having more and more of the tech stack on the front of the house for the restaurants is creating stickiness and is lowering churn. I don't think, or I wouldn't say that that's the reason why the churn is falling this half year, because the fundamental change in number of POS installations that we have are not that significantly changed. However, we just released, as you probably, I don't know what you saw, but we just released a new POS version, so a cloud-based POS version, which is extremely strong, tailor-made for the QSR segments, and we are seeing traction of that in the market, both in Germany, but in particular in the old OrderYOYO part of the business, so in the northern parts of Europe, especially in the UK and Denmark.
And I think this is one of the drivers. Maybe you can remind us, as a pizzeria, what do I get out? I understand the business model of you having a web page. I understand the business model of you driving traffic to that web page and handling all the transactions on that. But getting a POS system on top of that, what is that giving the customer extra? Maybe to remind us, so I'm not sure I maybe ever have heard it from you.
No, but basically what it does is that you could say if that you have the digital order in the middle of a blank piece of paper, and then there's basically three pillars around that. So you have one which is basically how you grow the customers. So this is all about the marketing part that we've been doing a lot. Then you have actually all the payment structures, so all the financial solutions, which is all about payments. And then you have all the operations of the business of the restaurant. And obviously, basically what this is, this gives the restaurant another tool to operate the business more efficiently. And the thing here is that, so if you buy our POS system and also have our web system, the menus of the POS and the website and the shop system is 100% aligned. Which is a tremendous cost saving and hassle saving for all, especially in quick service restaurants or in takeaway restaurants. This is something that normal POS systems actually do not do, and we do that. Number one. Number two, then obviously you will get the ability to see all your transaction in one place, which is the POS system. So it gives better operations of the restaurant.
And does it make you able to maybe go after a little bit bigger change than you normally have had? Is that also a factor here?
We both our shop system, our financial solutions, our marketing space, and our POS systems, we are actually able to go for bigger change if we wanted to. Now, what we're doing right now is that we want to focus on the quick service restaurant part, so the small part of the business right now. But we do have chains up to 7-8 restaurant outlets. But there's nothing in our systems that couldn't handle a chain. What's different from handling a chain is basically all the customer interaction. So it's a different beast. And a chain normally would look into companies like ours, expecting some kind of agency add-on that we do not want to give. We want to be a scalable software business and being that 100%.
Perfect. Then there's a question: can you give us any color on the current M&A pipeline and if you expect to close more deals this year?
No. I mean, obviously we are looking at this all the time. We've talked about this before. M&As are tricky. Either they come or they don't. But we do have a fairly strong pipeline in this area. It is a very important part of our business, as it's been on and on. But I can't comment on specific things.
Of course. But the pipeline looks okay. That we get out of you.
It does.
Then there's a final question. When do we expect positive free cash flows? I guess you are now guiding this cash EBITDA, and I guess that's as close as synonym to cash flow positive. But can you give some color on whether that's fully true, or whether there's a little bit longer before you will be?
You could say that there are two things here. So the cash EBITDA is the closest. Is basically the metric that makes most sense for us also to guide and manage our business after, because that's the operational part of the cash flow situation. Then there are basically three components that we need to subtract from that, basically, right? So there is the extraordinary costs that we have in EBITDA. Yeah. Then there is financial expenses, so interest on the loan that we have, which is not that big, but it's there. And then the last thing, which is the big reason why it's difficult for us to kind of guide on when we will be cash flow positive on, all the way down, because the whole M&A side of business is obviously what skews this a lot. Because when we do these, part of payments, that was the situation in King Food, for instance. It was actually also in AppSmart. Part of the payment is sometimes a cash payment. There are transaction costs. So that will skew that picture quite a bit, and that's why the cash EBITDA is the closest thing that we get to a functional cash flow metric for us. Yeah,
that makes sense. The other ones is hard to guide on.
It is.
You don't know whether you're close an M&A deal, and I guess that's the biggest actually. Yeah.
And that is the biggest one. What you can say is that our capital base is quite sufficient, and you can see that from our balance sheet on the first half year here as well, where we have 53 million in cash. So what's important here is that if we decide not to do any M&A, or we don't, even if we do the ones that we have in place here, we are not dependent on anybody outside of our company to drive the growth or drive the business plan that we have. And actually also the M&A activity that we do look at now is actually fully funded with the cash that we have at hand right now. So in that sense, it gives a lot of flexibility and freedom, which in this market is very important. And as you remember, so just before we did the merger with AppSmart in 12 months ago, so half year before that, as I took over as full-time or long-term CEO, we actually did a capital increase at that point in time to be with the purpose of being in the situation that we are in now, to be 100% independent.
Yeah, perfect. Yeah, but I think that was the last question. Thank you to you, Jesper and Mathias, for taking us through your results and answering questions. And thank you for the audience for listening in.
Thank you so much. Thank you, Michael.
Thank you.
Thank you.